we are discussing the chapter Departmental Accounts. So please be quiet. No performance and all. Listen friends, in this chapter we prepare financial statements, that is final accounts of departments, which involves trading account, P&L and balance sheet of the departments. The need for preparing departmental trading and P&L is to find out the departmental profits and losses. The need for finding departmental profits and losses is to evaluate the performance of the management of the department as well as taking key decisions such as whether to continue the business or not, that is the department or not. The unique aspect of departmental final accounts being apportionment of common expenses, elimination of unrealized profit. Unrealized profit arises only in the event of there is inter-departmental transfer of goods or even services at a profit margin, and such goods are lying unsold. Then you have unrealized profit. Unrealized profit, that is stock reserve, is computed based on the closing stock of transferee department, and such unrealized profit shall be eliminated from the, not from transferor department, from the general P&L. This was our discussion. Now the computation that has been made from based on the stock of transferee sometimes will eliminate from the transferor department. Sometimes we will eliminate from the. Sometimes what happens, the departmental manager's remuneration may be based on the profits earned by the department. Everybody, departmental manager's remuneration is based on profits earned by that department. And in the absence of information, always such profit will be the realized profit, and it is not the profit which is booked by the departmental accounts. It has to be based on the realized profits of the business, because the business can't give the remuneration on the unrealized profits. So business will give remuneration only on the realized profits. So in such cases, then the unrealized profit shall be eliminated, that is stock reserve shall be eliminated only in the concerned department, that is transferor department. Now listen friends, I told you pre-lunch session that generally the unrealized profit shall be eliminated in the general P&L. We continue, we stick on with to that particular point. But if the department manager's salary is based on the departmental profits, then it will be generally based on the department's realized profits, and thereby we eliminate the unrealized profit from departments. Are you following? It may be, you may be asking, sir, what if A transfer to B is not selling, then no remuneration to A. It is primarily because A transferring goods to B, maybe it's a very negligible transaction. The major revenue for A will be selling to outsiders. Are you following? So generally in such cases, in the absence of information, unrealized profit will be eliminated from the concerned department if the question involves managerial remuneration computed on profits of department. Then unrealized profit, stock reserve will be removed from the respective department, not from the general P&L. Understood? Appa? Otherwise, no such remuneration and all, sir, then general P&L. Understood? So please do bear such points in your mind. Let us move into the problems. We have a target of 6 questions only. 6 into 15, 1.5 hours. So the moment that is over, we are leaving. So 6 into 15 means it's 1.5 hours only. Understood? No. That is too much. Okay, friends. Friends, please be quiet. Let us solve problems. Totally 8 questions. 1 question over. Remaining 7 questions. Another 1 will be gifted. Remaining 6 questions. In that we want to solve only 5 questions only. Target is revised. We have only 5 questions to be solved. Understood? But with 1 gift, that is how it is 6, 5 plus 1. Understood? So let us now focus. Question number 2. Page number 128. Complex Limited had 3 departments, A, B and C. The following information is provided. Opening stock, consumption of raw materials, wages, closing stock, sales. Stock of each department are valued at cost to the department concerned. Stock of A department are transferred to B at a margin of 50% above departmental cost. Stock of department B department are transferred to C department at a margin of 10% above departmental cost. Other expenses were salaries, printing, rent, interest paid, depreciation. Allocate expenses in the ratio of department gross profits. Opening figures of reserve for unrealized profits on department stock were Department B 1000, Department C 2000. Prepare departmental trading and P&L account. Kindly go through the question once again, please. Kindly go through the question once again. Thank you. Now please go through the question once again. Okay. Regular pattern only followed. I realize that. Please listen, friends. Complex Limited had 3 departments, A, B and C. After giving certain particulars about A, B and C, they are telling what exactly the activities at each of the departments. A department transfers to B department and B department transfer to C department. A to B, B to C. C will only make sales to outsiders. So A will not make any sales to outsiders. B will not make any sales to C only will make sales to outsiders. A will transfer the goods to B at a profit margin of cost plus 50%. B to C, cost plus 10%. Like that we identify or we will be recognizing the profits. Everybody? Then they have given certain expenses and they told this allocate expenses in the ratio of department gross profit. No different basis and all. Identify the gross profit of each department. In that proportion only you will apportion the expenses to various departments in P&L. Correct? After which you should be knowing, here we understand there is interdepartmental transfer at profit. So there is possibility of stock reserve. So we should also prepare dash account. General P&L account. Understood? Here the stock reserve will not be eliminated from that department. It will be eliminated only in. There is no remuneration to the department's manager and all. Understood? So we are going to prepare departmental trading account, departmental P&L account, general P&L account. This is our solution. We have departmental trading, departmental P&L and general P&L. Shall we? Now listen, friends. Opening stock indicated here. Opening stock indicated here represents opening stock of finished goods. Opening stock of finished goods at the each department. Why like that conveyed? Na? The next information is what? Ba? Consumption of direct material, which means direct material, raw material, that's correct. Consumption. So which is nothing but opening stock plus purchase minus closing stock of raw materials. Correct? So this opening stock represents what opening stock? Finished goods. This consumption includes opening stock plus minus closing stock. Correct? This does not include this 3000. 3000 is different, which is purely opening stock of finished goods. Wages, closing stock, sales. Correct? Please respond, friends. It's a processing department. So processing department will have opening stock, then raw material consumed and the labor, you have sales, closing stock. Everybody, please respond, friends. There is only one item missing as far as trading account is concerned. The transfer made by A to B is revenue for A, cost for B. Transfer made by B to C is revenue for B. That is not there. Are you following? So that information, a departmental transfer amount is not there. So sales is given only for whom? A's revenue and B's revenue not given. So how to find out that? Very simple. This is finished goods. Then whatever cost given is the current year production cost. Everybody. So opening stock plus current year production is the total goods available at department minus closing stock is a good sent to the other departments. Are you following? What is A's duty? To send the goods from A to B. Correct? Respond. So this is opening stock of finished goods. Then we have current year production, which is raw material and labor. So you will got total goods available in the department A. From there, at the end, this much only we have, which means balance goods and all sold. Transferred. Understood? Transfer at the same amount or with profit? Add the profit and compute what is the transfer made by A, which will be booked as revenue for, cost for. Similar way you should also work out for B. What is the total goods available minus closing stock is the goods sent to with a margin of 10%. With a margin of 50% margin is for A to B. Now B to C 10%, which will be the revenue for B and cost for and C's revenue separately given 34,000. Could you appreciate that? So prepare the trading. You will get GP. Take the GP, apportion all these expenses in GP ratio, GP proportion. You will get net profit. Respond. Take the net profit in general P&L. Then they have given opening stock reserve 1,000 and 2,000. Correct? When I say department B 1,000, it is not stock reserve to be eliminated from B. It is based on the closing stock of B. Correct? Closing stock reserve is computed based on whose stock? Transferor stock or transferee stock? Unrealized profit is computed based on whose stock? Transferee stock. Now here A transferring to B transferring to which are all the transferee department? Which is the transferor? Appo whose stock should be considered for finding stock reserve? B and C. Adhan solranga. B's stock had reserve of and C's stock had a reserve of total opening stock reserve, which will be credited in general P&L. Which will be credited in. You also take net profit from the departmental profits. So then you will find out closing stock reserve. You should find out closing stock reserve. Correct? Identify the closing stock of department A, B, C or only C or only B. B and C. Identify the closing stock of and identify the margin booked by A as well as margin booked by and you total that. That is the closing stock reserve. So general P&L format by opening stock reserve by net profit of all the departments together. No separate columns and all. Everybody. So then you will debit closing stock. You will get net profit of the business as a whole. Understood? This is our solution for this particular question. This is a 16 mark question, my dear. The last question what we solved was only an 8 mark question. Now the question what we are going to solve is a 16 mark question. Are you following this? The solution wise it is departmental trading P&L as well as general P&L. It is also solution, not a working note. Correct? Working note wise what you will do? You will find out the value of transfer. Value of then closing Closing. These are the two computation, primary computation you should make. One is value of transfer, other one is closing stock reserve. Shall we proceed, friends? More of computation. We already structured the solution. Department, trading, P&L, then general P&L solution. Working note number 1, value of transfer. Working note number 2, closing stock reserve. Then put that into the trading P&L. If the entire solution is over, 16 marks ready. Understood? Respond. ஒன்றும் சொல்றதுக்கு இல்லை. Question number 2. Friends, please be quiet. Department. Trading and you have A, friends, please be quiet. Value of transfer. Which departments making transfer? A and B. So let us take for Department A and Department B. Being the second question, I want you to listen. Please listen. I will do. You please sit and sleep. பிச்சு கூட வந்துச்சு. பொழுதுருவேன். Friends, be quiet, please. Friends, be quiet, pa. Please don't write simultaneously. Actively participate in the discussions, computations, calculator usage, all these things. Similar question with the numbers change I will gift you. You can do that time. Now please listen and try to understand the problem. So when you are writing simultaneously, you are actually in half sleep mode. Okay. Please don't do that. Please listen, friends. See, class ஆரம்பிக்கலாமா? Okay. Please listen. We need to find out the total goods available at the department. We need to identify the total goods available at the departments. For that, I should take opening stock of finished goods and the current year production. Opening stock, how much? 3,000. 4,000. Current year production. Listen. This current year production will have two types of cost. No. Now listen, friends. Please listen. One is called own cost. The other cost we call it as transfer in cost. The cost which has been transferred from the other department. Everybody? This transfer in cost will not be there for department A, but will be there for department B. Everybody? So now let us take own cost. You have raw material consumed. It is 8,000. And B? Wages. The transfer in cost is nil here. Everybody. That way, the current year production is 13,000. Current year production is 13,000. Everybody. Here transfer in cost, how much we should find out. We can't take nil. Everybody. So we can't find out even the total cost also. Everybody, current year production we have to wait. Okay. Now, goods available. Goods available at department A. How much? 16,000. Goods available at department A is 16,000. Everybody, we can't now work out for department B. Minus, this is the total goods available. In that, I am seeing still at the end of the year some more stock, which means balance goods center. So closing stock, which means the balance is the transfer made by at cost price. So this is called the cost of transfer. What is it? Cost of transfer. How much? 12,000. But A does not transfer the goods at cost price. It is transferring at a margin. Correct? Markup at 50%. 6,000. So thereby value of transfer. Value of transfer is 18,000. Value of transfer is 18,000. யாரா இருந்தாலும் வெளியே அனுப்பிச்சிடுவாங்க. யாரா இருந்தாலும் சொல்றேன். Now this 18,000 is the amount which is transferring cost for department B. Are you following up? So let me provide the information once again. If it was so congested, it's okay. Opening stock is 3,000. Then current year production having two components, own cost and transferring cost. Own cost is 13,000. Own cost is transferring cost. Own cost is 13,000. Transferring cost is nil. That way current year production is 13,000. Total goods available in that shop, in that department is, that was available during the year. At the end of the year, this much only available. So balance and all transferred. Balance and all transferred. So but that is only cost price. Transferred at a margin. Margin is 50%. So that way it is 18,000. Correct? So transferring cost is 18,000. Current year production, totally it is 40,000. My dear friends, this 18,000 and 22,000 are not two different types of goods. In a semi-finished stage, A transferring to B will incur further cost. B will incur further cost, everybody, on 18,000, completing the production as 40,000. So what is 40,000? Production during that year in department B. What is 4,000? Opening stock of finished goods, which means in that department B, what was the goods available? 44,000. In this, closing stock is 14,000. We find cost price of transfer is 30,000. Margin is 10%. So value of transfer is 33,000. Do you follow all these computations? So in each department, opening stock, current year production is the total goods. As we discussed for the other problems, opening stock plus purchase, the total goods available, minus sales is closing stock. Minus closing stock is sales. Are you following? So total goods available minus closing stock is the sales. But A doesn't sell. What A will do? Transfer. Then that is transfer. So 3,000 plus 1316 is the goods available. Closing stock 4,000. 12,000 is the cost of transfer. Plus markup 50%. So that way it is 18,000 is the value of transfer. Everybody, please respond, friends. Yes, then we have in department B, similar working is done. 4,000 is opening stock. Current year production of 40 will have two components. Own cost, transfer in cost. Own cost 22,000 and transfer in cost totally. Then like that we have 44,000 minus what is 14,000? Still goods available at B. So balance would have been sent at a margin of 10%. That way 33,000. Now listen. Let us now take this processing department's trading account to opening stock. 3,000. 6,000. To direct material consumed. We don't have purchases. It's a processing department. Still we call this trading account. 8,000. To wages. 5,000. One thing what you notice is in department C no cost is incurred. They don't incur any own cost. They will not have any. They will receive the goods in a processed form, in a finished goods form, and they will directly make sales. Correct? So now buy sales. Nil. 34,000. Now we will record buy transfer out. 18,000. 33,000 is the revenue for A and B. to transfer, this is the cost also, in nil 18,000, 33,000. A's revenue is B's cost and B's revenue is C's cost. Because the work of A is to transfer goods to B and work of B is to transfer goods to C. Understood, our friends? We will take now closing stock. 4,000, 8,000. To gross profit carry down. So 6,000, 3,000. Everybody? So what is the gross profit proportion, my dear friends? 2:1. Now, very simple. Our next part is so easily completed that our gross expenses will be apportioned 2:1:1. So buy GP 6,000, 3,000, 3,000. Two salaries. Correct? 2,000, 1,000, 500, 500. To printing and stationery. 500, 250, 250. It is the proportion of 2:1:1. Right? Next one. Rent. 3,000, 1,500. 2. 2. Depreciation 1,500. By net loss 2,000. Departmental trading and P&L will not have stock reserve. That is to be eliminated in. For that purpose only we prepare general P&L. Otherwise there is no need at all. Understood? So let us try that. General P&L. Usually we write by net profit. Here it is. To net loss of ABC 2,000. No separate columns, but just to take the total only I am writing like this. 4,000. By stock reserve opening relating to B and C 1,000, 2,000, 3,000. To stock reserve closing B, C. Take that amount. Which we have to find out. Our next working will be for finding, friends, stock reserve. Everybody? So, what was this working for? Transfer made by A to B, B to C. What is the concept behind that? Goods available minus closing stock is what you have sent, plus the margin is the value of transfer. That was the concept behind this. We put that into trading account, we got GP. Using the GP only, we apportion all the expense as directed in the question. Up to this you are clear? Yes, sir. Sorry. For around 16 marks, like we got now 9 marks or 10 marks. 6 marks only for finding closing stock reserve. Understood? So 16, let 10 got. So 6 marks we have to work now. So it is for finding stock reserve, closing stock reserve. Everybody? That will be a very, very simple exercise. The margin is 50% on. 50% on. Which is 1/2 on cost. The margin is 50% on cost. That is how much, 1/2 on equal to 1 by 3 on sales. Here we call this transfer price. 1 by 2 on cost equal to 1 by 3 on transfer price. Everybody?
Yes, sir.
Okay. Now we will compute the stock reserve first based on B's stock. When you take B's stock, whose margin is included? A's margin. Right up, Ale?
Yes, sir.
So, we find whose margin is included? Is it 1 by 2 or is it 1 by 3? Because we transferred at profit margin, correct? Whatever we transferred is the sale price for us. But that is the cost price of that department. So B would have valued their closing stock at their cost, which is our selling price. Our closing stock of B actually represent the selling price of A. Are you following? Should I apply 1 by 2 or 1 by 3? 1 by 3. 1 by 2 is on cost. Cost of department A. Are you following this? So A transfers with a profit margin to B, which is the selling price. A selling price is B's cost price. B will value the stock at cost price. Whose cost price? B's cost price, which is A selling price. Correct? So when I take now B's stock, I should apply the margin of A. Is it 1 by 2 or 1 by 3? 1 by 3, because 1 by 2 is on. So thereby we should apply 1 by 3. Clear? What is the closing stock of department B? What is the closing stock of department B? 14,000. Everybody? Now what is the margin?
1 by 3.
So thereby what is the stock reserve? 4,667. Can we compute? No. That is wrong. Listen friends, why we made a presentation for finding value of transfer that comprehensive manner, na? Just to tell you, demonstrate you that in every department there are two components of cost. One is called own cost, other one is called transfer in cost. So closing stock of department B will have two components: own cost incurred by as well as transferred from A. The profit margin is included only on the goods transferred from A to B. Whatever cost incurred directly by B does not have any profit margin. Whatever cost directly incurred by does not have any. You look into the production of department B. So there is a chart we have just presented, a table. Please look into the working notes. Our working notes, my dear. So in our working notes, you find what is the production of department. Oh, you're not copied. Okay. What is the production of department B? It is own cost of 22,000 and transferring cost of 40,000 current year production. 4,000 is previous year production. So let us take current year production. In that 22,000 is the 18,000 is the. So this is the proportion of own cost, and this proportion will be there in every 1 rupee of stock of department B. Every stock of department B, Baski, will have own cost and transfer from A. Are you following? Adala margin is included only for the transfer made from A. Closing stock of department B, how much? 14,000. In that 14,000, you have both own cost and transfer from A. Own cost, there is no profit margin. Own cost does not have any. Profit margin is there only for transfer from A. Could you appreciate that? Now, what is this mix? 22,000 is 2. 22,000 is 2. So what does that makes? How much percentage? Can you tell out of 40,000 what is the percentage of 11:9 in terms of percentage? 55%. And what is 55%? Own cost is 55%. Are you following? What is transfer in cost? 45%. Could you appreciate that? Which means I understand every 1 rupee of stock of department will have 55% of and 45% of. So we need only the transfer made from A to included in stock of department B. Correct? Appa 14,000 la we should apply 45%. That's 6,300 into 1 by 3. 2,100 is the stock reserve. Are you following this? Everybody, directly we can't work out 14,000 into 1 by 3. We understand in the department B there are two components of cost. What and all? That is why I was making from the beginning the discussion in that angle, own cost and in the own cost I don't have any profit. But when I transfer from A booked some profit. And that profit is unrealized profit. Correct? Respond pa. So why don't I assume this 22,000 is fully sold? First of all, you should get a pakka clarity that these two goods are not two different goods. These are same goods. These goods are semi-finished stage on which I incur further cost. So every goods you take, there will mix of both. What and all what? Own cost and transfer cost. Correct? Every 1 rupee that stock mix will be there. So thereby 14,000 also will have same mix. In that we apply 45%, which is the transfer made from A 6,000 into 1 by 3 2,100. Now whatever we discussed put into writing. Shall we? No, let me put into writing. You listen. Continue to listen. We are going to find out stock reserve. For that, let us identify certain other information. Mark up A to B, B to C. On cost 50%, 1 by 2. 10%, 1 by 3. On transfer price 1 by 3, 1 by 11. Margin over. Next. Proportion of own cost and transferring cost. For department B, production was 40,000. Own cost 20. Transferring cost 18,000. So percentage 55%, 45%. Everybody? Now let me arrive at stock reserve. Shall we? Stock reserve of department B. Stock reserve of department B. Let us take closing stock of department B. 14,000, which will have own cost exactly 55%. Transfer from A 45%. 7,000, 6,000. So this 6,300 will be, which is made up of cost and profit. Cost of A, profit of A. In fact, cost is irrelevant. Correct, Abba? So this is 6,300 into 1 by 3. 2,100. So, not required. Okay, Chuma will do that. Everybody? Thus, stock reserve of department B's stock is 2,100. Everybody? So, in our general P&L, we got 2,000. You see the alone missing. So, we got already now 10 marks plus another 3 marks now. 13 marks over. Now, 3 more marks. Understood? Let us take that 3 more marks. Shall we? That is easy or easy. You know why? Because there is no own cost. There is no production in department C. Everybody. Now C. Stock reserve of department C. What is the closing stock? 8,000. Everybody. Own cost transfer from A. Everybody. Own cost is nil. From B. 8,000. Correct? Which is cost and profit. Everybody. Which is 8,000 into 1 by 10. 1 by 11. 727. This is 7273. So we got another 3 marks. And I don't think this is wrong. Because this cost price of department B will have transfer from A. Listen friends. There was no own production in C. That's okay. Understood? This 8,000 is cost of B, profit of B. Cost of B, profit of B. Profit of B is 8,000 into 1 by 11, 727. Remaining is cost of B. Respond pa. Every 1 unit of cost of B will have own cost of B transfer from A. Understood? Appo, this should further be classified into own cost transfer from A. 55%, 45%, 4,000, 3273. This transfer from A is cost and profit. Correct? Profit of A, which is 3273 into 1 by 3. 1091. So total stock reserve is 1818. And this one is 21. Okay, Chuma. Are you all following this? Closing stock of department C is nothing but goods processed at B plus B's profit. You identified B's profit as 727. Respond friends. Balance you will get C, production of B minus closing stock. In that you have added margin, no? When you add margin of 3,000 on this 30,000, what is 30,000? Cost price of B. But you should know one thing, that the 30,000 includes transfer from A also, as well as own cost also. Are you following? Whenever goods are processed at department B, ready for transfer to another department, in the transfer from A is also included, you should know. Understood? Ram Prakash? Tukam. So now listen. So 8,000 is nothing but cost of B, profit of B. Profit of B is balances. But we already analyzed that whenever there is cost of, there are two components in that cost. Own cost, transfer from A, own cost and. So thereby, and which will have a proportion of 55 and we got 4,000 and 3,273. Are you following this? 3,273 is the transfer made from A, which is representing transfer price. Are you following? So we are finding out the profit margin included in 3,273. Understood? But what is the final conclusion? CO the stock will have margin of as well as margin of B. C stock will have margin of A as well as margin of B. Understood? That way 18, 18, 18, 18, 3918 by net loss of the business 4919. That's all. See, marks. Friends, when the cost price of Department B, if it is 100, if the cost price of department is 100, say 100, which will always have two components. Own cost, transfer from. How much will be the own cost? If 100 rupees is cost price, then we find 55 will be the own cost and transfer from A will be 45. Everybody? Now in this, transfer from A transferred these goods. A transferred these goods with a 50% margin on cost. Department B, cost price plus 50% margin, that is 1/2 on cost. Respond, friends. Which means in 45, what is the profit margin? 1/3. How much? 50. What is cost price of Department A? It is on 30, 50% margin was 15. Together it reaches B at B incurs further cost of, make the cost of, and transferring to Department. Everybody, it reaches with a profit of 10 and finally it reaches at 110. This presentation, did you understood?
Yes, sir.
So finally when the goods reaches Department C, it will have a cost of 110. Respond. In this 110, in the chain, there are two profit points. 15 and 10. These are the profit points which are included in dash price. In C's cost price of 110. Is that clear? Up to this pakka? So, if you understood this, then stock reserve of Department C. What is the closing stock of Department C? 8,000. C will have 25 rupees profit in every 110. One eight. I told you, we are professionals, always we need to think in a different viewpoints and that. Okay. Friends, so thereby we could avoid all these big workings and we arrive at that 1818. Understood? Now, this working also will avoid. Everybody, where we find out the stock reserve Department B, how much? 2,100. Now listen, friends, when it reaches B, or what is the total cost price of B? In 100, what is the profit point? So thereby of department B, 14,000 into profit is 15 out of 100, 2,100. So that's it. We got 300. Quickly. Question number 5. Question number 5, page number 131. Interdepartmental transfer, stock reserve and managerial remuneration based on realized profits. Messrs. B and Co. had 4 departments A, B, C and D. Each department being managed by a manager whose commission was 10% of the respective departmental profit, subject to a minimum of rupees 6,000 in each case. Interdepartmental transfers took place at loaded price as follows. From Department A to Department B, 10% above cost. From A to D, 20% above cost, C to D, 20% and C to B is also 20%. For the year 31st March 2014, the firm had already prepared and closed the departmental accounts. Accounts has been already prepared. It was discovered that the closing stock of department had included interdepartmentally prepared goods at loaded price instead of cost price. From the following data, prepare a new statement. Department A, B, C and D, profit of all these 4 departments reported. Interdepartmental transfers included at loaded price in the departmental stock. Of Department B, 70,000 and Department D, 4,800. The breakup of 70,000 is 22,000 from A, 48,000 from C, 3,600 from C and 1,200 from Department A. Kindly go through the question once again, please. Listen, friends. Messrs. B and Co had 4 departments, A, B, C and D, out in which each department being managed by a manager whose commission was 10% of the respective departmental profit. Unless otherwise mentioned, I told you, it is always based on the realized profits. Which means the stock reserve, if any, should have been eliminated from the concerned department. Which is concerned, transferee or transferor? Is it from transferee department or transferor department? Transferor. Transferee's profit does not have any profit included. It is computed based on the stock of transferee, but eliminated from, because transferor only had booked profit. A transfer goods to B. Who booked the profit? A. So from A only it has to be eliminated. Understood, our friends? Respond. Head office transferred goods to the branch. Branch not sold the goods. So profit will be eliminated in head office, unrealized profit. Understood, Abba? So thereby transferor department. So here they told you that there is also a condition, minimum managerial commission will be 6,000 rupees in each department. They are also giving you the terms of transfer, A to B, A to D, C to D, C to B. From this information I understand, out of the 4 departments, only 2 departments are transferor and 2 departments are transferee. A and C are transferor and B and D are transferee departments. Are you following up? For the year ended 31st March 2014, the firm had already prepared and closed the departmental accounts. Departmental accounts already they have closed. Later on only they discovered that closing stock of department has included inter-departmentally prepared goods at loaded price instead of cost price. Are you following? Now we need to identify such stock reserve included in the stock of transferees department and will be removed in transferor's profit. They are asking you prepare a new statement. New statement means they want you to find out or show a statement showing revised profit. They have reported the profits of the departments, correct? Please respond. These are the profits of department after considering all incomes and expense of department, including managerial commission. The manager's commission was already accounted, but we find that in this profit, dash was not eliminated. And thereby manager's commission is wrong. Now what we should do? Take this profit eliminate the managerial commission, deduct the stock reserve. Now deduct the manager's commission. That is what your new statement. Your new statement will be what, Bob? Profit, which is given after commission, add back commission, because that commission wrong. First, whatever given, you add back. Then reduce stock reserve, unrealized profit, for which you should make separate computation. Are you following? That stock reserve will be deducted. Respond, friends. Now you will get realized profits. You will get. Then now you provide manager commission. You will get the revised profit. Are you following this? This is how you are going to process. It's simple working. But it will come at least in the examination for 4 times, my dear friends. Such an important area. It has come and it will come also. Understood? So that way we are going to move into this problem. Shall we, friends?
Yes, sir.
In this, when we prepare a new statement, we should understand that we are not going to take all the departments for the revision, because the elimination of unrealized profit will affect only dash departments. Transferor department, that is, it will not affect the profits of transferee department, that is B and D. But the stock reserve will be computed based on the stock of B as well as D. B stock how much? 70,000. Now I should know out of that stock how much was transferred from A, how much was transferred from, then only I can apply respective margin. Are you following? Whose breakup is given in the question? 70,000. In that 22,000 is from A, 48,000 is from C. Understood, Appa? Please respond. So let us have the solution here. For solution statement, it is like this: profit after commission, add back. You will get profit before minus unrealized profit. Understood? Minus unrealized profit. Stock reserve, unrealized profit. Correct? You will get realized profits minus commission. Revised profits. For that, supported by a working note. Computation of stock reserve. Computation of stock reserve. We will compute. This problem is over. Is that clear to you, friend? Very, very easy area. Don't think that it's a big issue and all, big concept and all. In departments, it is only department final accounts. And final accounts related certain adjustments. So commission is one such adjustment relating to the final accounts. Could you appreciate that? Please respond, friends. So let us quickly complete this problem. Question number 5. Solution. Statement showing revised profits of department profits. Department A and department C profit after commission, add back commission minus unrealized profit. Let me call this stock reserve. Minus elimination of unrealized profit will affect only the profits of transfer or department. That is A and C. You can provide the comprehensive that it will not affect transferee department. That is B and D. Everybody, that is why in the statement you are taken only A and C. So B and D's profit remains same. Whatever given in the problem, that remains same. We are going to change only the profit of department A and department C. Working note wise, the first is markup. A to B, A to D, C to A, C to C to D, on cost 10%, that is 1 by 10, 20%, that is 1 by 5, 1 by 5, 1 by 5, on transfer price stock reserve. Everybody? Closing stock of department B. Closing stock of department B. 70,000. Transfer from A. Transfer from C. 22,000. Stock reserve 1 by 11, 1 by 6. How much? 2,000, 8,000. Everybody? Closing stock of transfer from A, transfer from C. 3,600. Now friends, please stop that. Wait. Stock reserve. One by 6. 1 by 6. 200. Total stock reserve for A 2,000, 8,000. I will give plenty of time for copying data. Now listen friends. Profit after commission. I want your attention here friends. Profit after commission. 38,000. 70. Now friends listen. The commission which has been already deducted, I want to add back. Sir, commission deducted, how do you know? Departmental accounts has been already closed, which means managerial commission has been already computed. Now I should reverse the commission. Everybody? The terms of the commission is that there is a minimum of the 10% commission with a minimum of 6,000. If the department profit is 50,000, if the department profit is, then 10% of 50, but you will give. If it is 55,000, you will give. If it is 58,000, you will give. If it is 65,000, you will give. 6,500. So 10% you will give, but minimum 6,000. Understood? In that case, how much you would have given here? 6,000. Because already the department have incurred loss. But you can't tell no commission. There is commission. How much? 6,000. And 8,000. Correct? Because it is not 72,000 on which 10% was given. On X amount before commission, 10% was applied and that was given as commission. Balance is 90%. So 72,000 is not the profit. 72,000 is only 90% of profit. Are you following this? So thereby here the computation is 72,000 divided by 90 into 10. Into 100 if you do, you will get 80,000. On that 80,000 only 10%. So which is 8,000. Understood? Everybody? So, yes. 32,000. 80,000. So do you follow this computation? On X amount, 10% was applied. On X amount, 10% was applied and you are given in the form of commission which represents. So thereby the balance profit represents 90%. So 72,000 is not the profit on which you gave commission. 72,000 is after giving commission. So thereby 72,000 represents 90. What is 100? We found out and accordingly we worked out. Purinjada? Stock reserve 2,200 to be deducted. 8,600 to be deducted. 34. Commission. Again 6,000. No change at all. Correct? So 40,200. Loss will increase. 7140. 64. That's all. For this only 6 marks. Question number 7, page number 132. Question number 7, page number 132. Department R sells goods to Department S at a profit of 25% on cost and the Department T at 10% profit on cost. Department S sells goods to R and T at a profit of 15% and 20% on sales respectively. Department T charges 20% and 25% profit on cost to Department R and S respectively. Department managers are entitled to 10% commission on net profit subject to unrealized profit on departmental sales being eliminated. Departmental profits after charging managers commission but before adjustment of unrealized profit are as under. Stock lying at different departments at the end of the year are as follows. Transfer from Department R. In R nil, in S&T amount is given. Transfer from Department S. In R and T amount is given. S to S is nil. Transfer from Department T. 9,000 and 7,500 for R and S. For T it is nil. Find out the correct departmental profits after charging managers commission. Like the previous question only, friends. Profit after This is profit after commission. Add back commission minus stock reserve minus commission. Revised profit. For this you should compute what? Stock reserve. There are three departments. R, S, T. All these three departments are transferor department. All these three departments are transferee departments. Very clearly they have given how much of R stock included in S and T's closing stock. Everybody. So thereby you will apply the margin of R to S and T separately and find out stock reserve. Shall we? Let us provide the similar matrix presentation and let us arrive at the stock reserve. Shall we proceed? Everybody. Now let us arrive at the statement. Statement showing the revised department profits. Question number 7. Solution. Statement showing the revised statement showing the revised department profits. In this department R, department S, department T. Profit after managers commission is 54,000, 40,500, 27,000. Add back commission, which is 54,000 by 90 into 10. I hope you are understanding the computation. Same, no explanation required. 40,500 by 90 into 10. 27,000 by 90 into 10. 3,000. Profit before commission 60,000, 45,000, 30,000 minus stock reserve minus managers commission For this, we would like to work out what? Stock reserve. We'll be computing stock reserve. transfer by department or department S, department T. Transfer by department are included in stock of department or department S, department T. Total. Everybody? Transfer by R to R, transfer by R to S, transfer by R to T. Like that we are computing. Everybody, friends? Transfer by R to R will not be there. S to S will not be there. T to T will not be there. Everybody? Now let us take R to S. How much? 22. Identify the margin of R to S. 25% on cost. 25 by 100 on cost equal to 25 by 125 on sales. So thereby 22,500. 22,500 into 25 by 125. How much? 4,500. Then R to T. R to T 16,000. 16,500. What is the margin, friends? 10% on cost. 10 by 110. The total stock reserve to be eliminated from R's profit is 6,000. Everybody? Similarly, for S to R, how much stock? 21,000. Let us identify the margin. 15% on. Thereby I will apply 15 by 150 na? 15 by 100. It was given as sales. So thereby directly 15 by 100, there is no need for conversion. Understood? So thereby it is 15 by 100. 3,150. Then S to T 18,000. 20 by 100. 3,000. So 67 is the total stock reserve relating to S. Total stock reserve relating to S. Everybody? Then T to R 9,000. 20% on cost. 20 by. So then 7,500 into 'That's all. Everybody? Now this stock reserve of R, S, T will be eliminated in their profit. It is 6,000, 6,000, 6,000, 3,000, 54,000, 38,000, manager's commission 10%. Can I turn this page? Anybody writing? Make it fast, my dear. Question number 6, page number 132. என்னாச்சு? Number 6, page number 132. It is related to some farewell issue, pa. Question number 6, page number 132. Goods and services of 3 departments, A, B and C, are also mutually utilized by them as and when required. Whereas goods are charged at 20% profit on cost. Services utilized are recovered at cost. Show how. Departmental profit shall be effected assuming the following facts. Department A, B, C. Goods and services supplied at cost by A to A nil, A to B 10,000, A to C 6,000, B to A nil, B to B nil, B to C 5,000, C to A 8,000, C to B 6,000. Note. Try the illustration on the assumption that the amount indicated is inclusive of services rendered. What would be the effect in the profit of the individual department when the service rendered amount is excluded in the figures given? See, this question a very long time back came in the examination, which is not a computation or something computing on profits. Between three departments there were some mutual transfers. Between three departments there were mutual transfer of goods and services. They are asking you what is an impact in the departmental profit. What will be the impact on the departmental profits because of this interdepartmental transaction? Are you following this? So please understand that A, B, C have mutually having transaction, and they are telling that goods are transferred at 20% profit on, but services utilized are recovered at cost. The question is, show how departmental profit shall be affected, which means whether it will increase or decrease by accounting for interdepartmental transaction, whether department profits will increase or decrease. Everybody, it's a presentation related topic. Transfer all departments, profits will, for transfer all department, the transfer is revenue. For transferee department, it is cost. By accounting for interdepartmental transfers, transferor profit will, transferee profit will. I would like to know what is the total transfer made by A, what is the total transfer made by, what is the total transfer made by, so that their profit will increase. Respond, friends. Similarly, what is the total transfer in for A, what is the total transfer in for, similarly for in for, which will reduce their profit. So as a transferor, my profit will, as a transferee, my profit will. What is the net effect is what we like to see. Are you following? So in this business, ABC's transfer information provided to you, you will arrive at total transfer out and total transfer for each department, and arrive at net transfer out or net transfer in, and you will make a comment. This department profit will increase by this much, this department profit will decrease, so and so department increase or decrease, like that you will mention. Overall effect on the business will be nil. Overall effect on the overall effect on the total profits will be nil, because business profit will not increase, departmental profits will increase but these transactions will not affect the overall business profit. Could you appreciate that? It is purely the same matrix presentation what we have just now made. So we would like to see what and all transfer made by A to B, A to B, A to C, total transfer out. Understood? For A, then B to A, B to B, B to C, total transfer by B, C to A, C to B, C to C, you will get total transfer by C, that column, correct? Now if you take column wise total, you will get transfer in for A, transfer in for, so whatever you are transferring out is credit, transfer in is, find net debit or, accordingly you can make the remark whether it is profit increases or, that is what they are asking. Show how department profit shall be affected assuming the following facts. Shall we proceed? Let us present that matrix presentation. With that, this problem will get over. Understood? Before that, let me announce that also. Question number 8 is actually the gift, my dear friends. Just glance the question number 8. Question number 8, if you see, it is the same question how we solved in question number 2. Understood? Respond pa. Almost many things are same. Now one thing is, when they have given margin, why transfer to at a gross profit of not 20% on cost, 20% on sales. So that information alone slightly change. You should be knowing how to convert that ratio. Understood? Otherwise, it is the same ditto like certain other things are salaries given, staff welfare expense given, rent given. Correct pa? Respond pa. These expenses are not apportioned in gross profit ratio. Area occupied will be used for rent and number of employees for salaries and staff welfare. Understood? That way you will be apportioning. This question number 8 is gifted to you. Everybody? Shall we? Now let us try this question number 6, the matrix presentation of transfer out by various department as well as transfer in by various department of two components, goods and goods will be supplied at 20% markup, but service will be supplied at cost. Shall we proceed? Let us arrive at this. Question number 6 la. Summary of interdepartmental transfer. Summary of interdepartmental transfer. Goods and services supplied by goods and services supplied by Department A, Department B, Department C. Here we will have goods and services received by Department A, Department B, Department total, which will show credit. Everybody? The information given, this total will give you the total transfer for A, for B and for C, which is debit totals. This row wise will give you credit transfer made by A totally to B and C. Are you following? That way this is transfer out and this total will show transfer in, B to A and C to A, everything will be there in the A's column. Could you appreciate that? What and all transferred? Goods, service, total. Goods, service, total. Goods, service, total. Total or total. Now listen friends, why such a presentation is required means, goods are transferred at a margin, but the information given in this table, is it including profit or excluding profit? Is it including profit or excluding profit? Because it is given at cost. So we have to add profit. But this 10,000 includes service na? First remove that service, balance is goods. Add 20%, you will get transfer price of goods. Add the service, total transfer. Are you following up? That is why I told it's only a presentation requirement. Cost price, markup, transfer price. Cost price, markup, transfer price. Cost price, markup, transfer price. Friends, please listen. Listen. We don't have time. Listen. Right. Now we find cost price. We find A to A, there won't be any transfer. Correct? This is not possible. Then A to B. A transferring to B. Friends, listen, but total 10,000, including service of 2,000. So thereby 8,000 is goods. Are you following the computation? No, don't overact, pa. So we find 10,000 and we find service of 2,000 and we get the goods of. Now these are all at cost price. Adding markup at 20% on goods alone. 1,600, nil 1,600. So this becomes 9,600. Is the supply of goods. 2,000 services at cost. 11,600. We actually require this one. This 11,600 is what we actually require. Understood? Now A to C. 6,000. 1,000. 5,000. Now there is a margin of 20%. Na? 1,000. Nil. 1,000. 6,000. Enough. Others will miss out. So we find total transfer made by A to C is 7,000. A to B is 11,600. Once again, 10,000 is total, including service. So it separated the service. Balance is goods, but that is representing cost. Margin is 20%. So 1,600. Total goods 9,600. Total service 2,000. Total transfer is 11,600. Similarly, we got 7,000. So it is 18,600. We find 18,600. Similarly, B to A. Wow, superb. B to B. Super. Now it is 5,000, 1,000, 4,000, 800, nil 800, 1,000, 5,800. So we require only 5,800. C to A. Yeah, 8,000 nil 8,000. 1,600 nil 1,600 nil 9,600. No service, only goods. C to B 6,000 1,000 5,000. பிச்சு விடுவா 7,000. 16,000. Now we like to arrive at total transfer in for A. So this last totals are showing that goods and no, that is not required. This total represent the total goods and services transferred out, and this last row total shows that it is, columnar total shows that transfer in made by various departments. Net it off and remark it whether the department profit will increase or decrease. So statement showing effect on departmental profits. Next statement. Statement showing the effect on இன்னைக்கு நைட் வந்துடுறாங்களா? There is a small change, pa. See, the first session will be at Rosie Davis up to 9 only. 6:15 to 9 and 9:45 to 12:30 audit. First session will be audit. PGDB major coverage 115 to 515. Okay, pa. Can I turn this page? Statement showing the summary. A statement showing the effect on departmental profits. Department A, B, C. Goods and services supplied, credit. Goods and services received. Goods and services received. debit. Net effect. Remarks. For A, what is the goods and services supplied? Received 9,000. Net effect 9,000 credit. So increases the profit. The interdepartment transfer increases the profit for department A. For B, 5,000. So friends, 12,000 decreases profit. 16,000 increases the profit of department C. Net effect nil, which means overall the business profit will not increase, or it is just the ABC's profit will increase and decrease. Everybody?